Hi, I'm Andy Whaley with AG Financial, and with me today is Kyle Dana, our Senior Vice President of Investments and Retirement. Kyle's been with AG Financial for 17 years, right?
Yes.
Providing leadership in two great areas here in the company, providing great products for countless pastors, individual investors all over the country. And Kyle, as you know, we get so many questions from around the country, people asking a variety of questions as it relates to investments. And so very excited that we get to take a few minutes here, address some of those questions. Hopefully we can help some of you out as you're thinking about investments and even retirement. So Kyle, just to kick it off, we've talked many times about why investors buy and sell at different times, and the fact that there actually is psychology behind that and how people make decisions. It seems that emotion actually plays a role when it comes to investments. And I was wondering if you can expand on that and just talk about what is the role of emotions with investments and what do people need to be thinking about?
Absolutely. I'd actually say that emotions play the biggest role when people make investment decisions. In fact, there is a whole field of science that's centered around what they call behavioral economics, which is how emotions factor into your decisions. And really, when we talk about investing, Andy, when we're talking about what people do with their buying and their selling of their stock portfolios, you have to look at it this way. We are inherently wired two ways. One, we don't like loss. We're risk adverse. And the second one is, which complements the first one quite well, is that we also don't like to miss out. So when we see that, for example, where we're at today with the stock market going to all-time highs almost weekly, people feel a sense that they're missing out. But reverse back to the Great Recession, 2008, 2009, when the market lost a significant amount within a short time period,
Sure.
And people's emotions kick in the opposite way and say, I don't want to lose anymore, get me out of this.
So you brought up an interesting point, stock market highs. We've been in a bull market for quite a while, right?
Actually, in March of 2017, we celebrated the 8th year of the bull market, which happens to be the second longest bull market run that we've ever had.
Gotcha. So I can see, wow. So I can see how that would definitely play a role as it relates to emotions when people see the health of the economy and this long-term bull market, thinking, wow, I really need to be involved in the stock market. But can you talk about when you lead with emotions, some of the ramifications, and really when it comes to investing outside of emotions, I mean, what do people need to be thinking when it comes to buying and selling, or contemplating not just when, but even what investments to buy?
Yeah, I would say that the most successful investors out there, if you look at the Peter Lynch's, the Warren Buffett's, the people that have successfully done this for years upon years, you have to be a good investor, you have to separate your emotions. It's okay to feel. It's okay to, I'm a little nervous, I'm scared, or I'm elated because my portfolio is doing so well.
Sure.
There's nothing wrong with the feeling, but separating the feeling from the actual decision making is what will separate a good investor from a bad investor. In fact, some people have even said that the stock market is nothing more than an exchange from the impatient to the patient. Which I love that, because if you think about it, people that are constantly getting in and out, and then you've got your person who's planted right there, and they are able to get great deals on the down and get out at a great time as well, because there's always somebody waiting to get in, there's always somebody waiting to get out.
So Kyle, that's interesting you say that. It reminds me of another question that we get often, and that is, it just happens to do with timing the market. So a lot of people say, how can I know when to get in or when I should be getting out? Right. And can you just elaborate a little bit more on timing as it relates to the market?
Well, I'd say this, if you can figure it out, then you'll be a millionaire. People are
Right.
constantly trying to time the market, and in most cases, not all, but most cases, they do it incorrectly, which actually does more harm to their overall performance in the end than had they just stayed the course the whole time. So to me, when you say timing, I would say time.
Okay.
Time is more important than timing. Timing is defined as getting in and out, trying to pick the lows, pick the highs. Time is saying, guess what? I'm not knowledgeable enough to know what tomorrow holds or what next week or next year. So I'm just going to pick something that fits my risk level, and I'm going to stay the course.
Sure.
And if you look at the historical performance of the stock market over the long term being 20, 30 plus years,
Right.
you'll find that although the market goes up and down in the short term, that overall the market goes in a general up direction. Is that guaranteed for the future? Not necessarily, but I would rather stop trying to beat the market and just do what the market does as a whole.
So what you're saying is, looking back historically, and obviously we're not giving advice or telling people what to do, but historically, time beats timing.
Yes.
Okay, I like that. One other area that I wanted to cover really quickly is in the area of retirement. So whenever anyone saves for retirement, whether it's a 401k, 403b, whatever it might be, there's that issue of asset allocation. Where do you want to invest the money? What do you elect to invest in? Are there different things that people should think about based on age when it comes to asset allocation? And just in general, when it comes to investing with retirement, are there just some basic principles people should be thinking?
Sure. I think the general philosophy in the financial markets is the younger you are, the more aggressive you should be because you have time on your side. The older you are, the closer to retirement, the more conservative you should be.
Sure.
And I would say that that would be generally a true statement, but here's what I have found over my 17 years is that your personality is far more important when choosing an asset allocation than your age.
What does that mean?
So basically, I'll come across a lot of 20, 30, 40-year-olds, right, who in theory should be more aggressive because they have 20, 30 years until they're going to retire.
Sure.
But what they find is they get into a strategy, the market goes south, they see negatives on their statements, and all of a sudden, remember those sense of emotions kick in?
Right.
I don't like to lose, and if I keep losing like this, I'll have nothing, or I'll end up owing money in the end. And because of that, they end up selling out, changing their portfolio. And then on the other end, when the market goes way, way, way up, like we've experienced since the Great Recession, then they get that sense of I'm missing out, and they want to get back in after it's gone up. So I have found, regardless of age, young or old, you first have to determine your own personality. If your personality fits, if you're okay with the fact that your performance could go up and it could go down, then you should probably be in a diversified portfolio. If the idea that you could potentially lose money makes you nervous, bottom line, you should not be invested in the stock market.
Okay.
What's interesting is I just had a client recently. This is a classic case. I think this best represents the conversation we're having as well as many conversations we've been having with phone and out in the field. But yeah. I had a client who had called me a couple weeks ago, basically had seen the news that the market was hitting a new high, okay? And since then has even hit a further high. But this client said, Kyle, I want to get back in the market. 63 years old. Now here's what was interesting. Be happy to help you. But when I looked deeper into their account, I looked all the way back to 2008, 2009.
Sure.
Because for me, no matter how I ask, when I ask people, I like to go back and see what they actually did.
Right.
That is the best indicator of your future behavior, is the past choices that you made. This particular client, at the bottom in 2008, early 2009, had actually been in the market and sold out.
Locking in their losses.
Locking in their losses.
Yeah.
It was too much for them to handle then. Fast forward 8 years, bull market, the market's up over 250%, and now they want back in? 63 years old. So you would think the closer you're getting to retirement, there's less of a case, there's less time to rebound or recover, and this person's still wanting to get back in. Why? Because the emotion is so powerful that they feel that they're missing out, that they will most likely get in. The market will have a correction because it always has corrections. And what's most likely going to happen, since they got in it at a high, the market corrects, what do you think they'll do?
Sure.
They'll get out.
Yeah.
Just like they did in 2008, 2009.
So that story, even though you just had one story from a couple weeks ago, is indicative of many investors, right?
Many of them. In fact, you can even see in the general market, even within our plan that we have here that we work with, we look at on a month-to-month basis within the plan, where is the money flowing?
Right.
So historically, especially during times where the market is down, you'll see money flowing out of stocks into stable. But in the recent times, in the last 6 months, even 12 months, you've started to see an influx of money moving out of stable into the stock market, which is usually an indicator that people are late to the game.
Sure. That makes a lot of sense.
I mean, Warren Buffett said it best when he said, be fearful when people are greedy and be greedy when people are fearful, which is a simplistic way of saying buy low and sell high. You can't get more simple than that.
I love that. That's good. That makes sense for investments. That makes sense for when you're investing in your retirement portfolio. That's just good wisdom, good common sense for people to hear. Kyle, thank you for your time today. We get so many questions, so addressing these issues I know is helpful for a lot of people. We invite you to look at our YouTube channel with AG Financial for more educational videos, some from Kyle, some from other experts at AG Financial, in addition to our blog. Thanks for joining us today. Hope you've benefited from Kyle's insights.